Hi everyone, welcome to this session of the Tiger Academy, US Stock Financial Statements for Beginners. In a previous practice session, I mentioned that we need to look at 3 separate statements when doing financial analysis. In this class, we take the balance sheet of Apple's 2021 financial statements as an example to analyze Apple's business operations. I'm sure you're ready to go. So, let's get started. So up to this point, we know that the analysis of companies can look at 3 important financial capabilities: profitability, solvency, and operational capacity. Profitability refers to a company's ability to make money, and solvency refers to a company's ability to pay its bills. Operational capacity refers to the operational efficiency of a company, which mainly depends on the asset turnover. So, what does the asset turnover mean? Let me give you an example. Let's say your friend Jack opens a hot pot restaurant in the mall. Business is booming and sales are great. Seeing this, Rose gets jealous, then borrows some money from her family and opens a hot pot restaurant right across from Jack's. Even though there are now 2 identical hot pot restaurants in the mall, there is so much foot traffic that both restaurants run at full capacity. Gradually, Rose notices something worthy of her attention. Although each restaurant has 20 tables and the dishes are similarly priced, all of Jack's tables are flipped twice during lunch and 3 times during dinner, whereas Rose's table are flipped only once during lunch and twice during dinner. Assuming revenue per table is the same, Jack earns 40 more tables of revenue. This is no small sum. In financial terms, Jack's restaurant serves 5 groups of customers per table per day, while Rose's restaurant serves only 3 groups of customers per table per day. In other words, Jack's restaurant has a higher table turnover than Rose's restaurant. Turnover, also known as asset turnover, reflects the operating efficiency of a company. Now that we understand the meaning of the 3 metrics, let's analyze them in the context of a financial statement. Now, I know that most investors focus pretty much only on the profitability of a company. For this reason, we'll start with metrics measuring profitability. To determine the profitability of a company in the context of a balance sheet, we'll focus on 2 ratios, ROA and ROE. So how do we find these ratios? 1. Enter Apple or its ticker AAPL in the Tiger Trade app, find Company, and click View Details. You'll see the specific data of both metrics in the next income section of the income statement and in the total assets section of the balance sheet. Apple's net income is displayed in the Tiger Trade app. Apple's total assets is displayed in Tiger Trade. We can now plug these 2 numbers into the ROA formula. ROA equals net income divided by total assets. Apple's 2021 ROA equals 946.8 divided by 3,510.02 equals 26.97%. Using the formula, we quickly find that Apple's ROA in 2021 was 26.97%. But we need to consider at least 5 years of data when we look at earnings data. So we calculate Apple's ROA for the years 2017 to 2021 using the same method. After calculating Apple's ROA over 5 years, we can analyze the meaning of this indicator and draw 2 conclusions. 1. Apple's ROA has been in an upward trend over the past 5 years, and its profitability has steadily increased. 2. Previously in the course, we mentioned how it is not practical to only compare ROA between companies. It's smarter to look at the total assets of companies within its industry. If the value of the total assets of a company is ranked highly within its industry, and the ROA of a company is also at the top, it means that the company has capital advantages and sustainable competitiveness. According to our data, in 2021, Apple ranked in the top 5% within the technological hardware and equipment sector in terms of ROA, and was in the top 3 in terms of total assets. So, it can be seen from the analysis above that Apple has ample cash and is highly profitable. Let's now look at Apple's ROE over the past 5 years. Apple's ROE ranking over the past 5 years according to Tiger Trade financial data. From this table, we can draw the following 2 conclusions. 1. Apple's ROE steadily rose over the 5 years reported, indicating improving profitability. 2. ROE for each year is far above Buffett's 15% threshold for investment. Among the 204 companies in the hardware and equipment sector, Apple's ROE consistently ranks in the top 1%. As we can see, Apple demonstrates excellent ROE. Analyzing Apple's ROA and ROE over the past 5 years, we can see that it is a highly profitable company. However, we need to take other factors into consideration when analyzing Apple. Next, we'll take a look at the solvency of Apple, which will tell us whether the company is able to meet its short-term debt obligations. For this, we'll focus on two ratios that measure solvency. 1. Current ratio. 2. Quick ratio. The higher the current ratio, the more liquid a company is, and the greater its ability to cover its current liabilities. The quick ratio is the ratio of quick assets to current liabilities. It is a measure of the company's ability to quickly liquidate current assets to pay current liabilities. In the financial analysis section of the Tiger Trade app, we can quickly find these two ratios. The performance of the two ratios over the past 5 years is summarized in the table below. From the data in the table, we can make the following conclusion. 1. Generally speaking, a current ratio above 2 is deemed excellent regarding solvency, while current ratio below 1 indicates poor performance. 2. Over the past 5 years, Apple's current ratio has hovered between 1 and 2, demonstrating strong solvency. Moreover, as I've mentioned in previous sessions, we should look comprehensively at a company in our analysis of the current ratio and not focus only on the value of the ratio. Apple's current ratio over the past 5 years has maintained relatively consistent, which indicates steady cash flow. We also found that inventory and accounts receivable have remained steady during this period, indicating no pileup of inventory or bad debt. Generally speaking, a quick ratio of 1 is considered normal, while a quick ratio below 1 shows solvency risk regarding payment of short-term debt. A quick ratio above 1 indicates poor cash management skills. Apple's quick ratio over the past 5 years has hovered around 1 with limited fluctuation, indicating excellent cash management. After so easily examining Apple's current and quick ratios, don't you feel more confident about financial analysis? Tossing out certain other confusing metrics and data made it easy to understand its financial statement. If you stick with the Tiger Academy course, your analytical skills will continue to improve. Now, let's move on to analyze the third ratio, asset turnover ratio. Asset turnover is like the table turnover in Jack's restaurant. It's the number of times a company does business with its customers. High turnover usually indicates higher profit, and so is always considered a good sign. Exactly what indicators do we look at under asset turnover? I suggest that we look at 4 main ratios, namely total assets turnover, fixed assets turnover, accounts receivable turnover, and inventory turnover. With turnover ratios, it's the higher the better, because that generally indicates strong operational ability. We can find Apple's asset turnover ratio components in the financial analysis section of the Tiger Trade app. What do these 4 ratios actually mean, and how do I read them, you may ask? Not to worry. In this next session, I'll explain everything to you. First is total assets turnover. Apple's total assets turnover ratio in 2020 was 0.83. But what does this mean? Generally speaking, total assets turnover below 1 over the long term indicates a company in a capital-intensive industry that is burning through cash. In layman's term, the company invests $1 billion in assets to generate only $830 million in revenue. As investors, we should approach this type of company with caution, except in the following 2 cases. 1. Capital-intensive companies with steady and long-term profitability, such as TSMC, Apple, and luxury goods companies such as LV. 2. Capital-intensive companies with ample cash, such as Alibaba, Google, and Tencent. Total assets turnover below 1 generally indicates that a company is in a capital-intensive or luxury good category. Total assets turnover above 1 indicates excellent, and a ratio above 2 is an even better sign. Next, let's take a look at fixed assets turnover. Fixed assets turnover shows the number of transactions a company does with its fixed assets. Because it is so similar to total assets turnover, we'll skip going into detail on this ratio. Now, let's move on to accounts receivable turnover. Apple's 2021 annual report states that its accounts receivable turnover was 17.26 for the year. This indicates that in 2021, the company did business with its accounts receivable 17.26 times. Put another way, 260 days divided by 17.26 yields 20.9 days. This means that the account receivable turnover for Apple was, on average, 20.9 days. In today's globally connected business world, it pays to be quick. So the shorter the turnover time, the better. A high accounts receivable turnover ratio indicates increased efficiency and is a good sign for the financial health of a company. Last but not least is inventory turnover. Likewise, in the case of inventory turnover, the higher the better. The table shows that Apple's 2021 inventory turnover was 40.03, which indicates that the company sold out and replaced its inventory 40.03 times in 2021. If we divide 360 days by 40.03, we get 8.9 days, meaning Apple turned over its inventory every 8.9 days. This is a very high rate of inventory turnover for the sector. That wraps up today's case study for Apple's balance sheet. Let's now summarize. Today, we learned how to access 3 key financial indicators of a business: profitability, solvency, and asset turnover. Profitability can be measured mainly by ROA and ROE. Solvency can be determined using the current ratio and the quick ratio. The asset turnover ratio can be broken down into total assets turnover ratio, the fixed assets turnover ratio, the accounts receivable turnover ratio, and the inventory turnover ratio. I've put together this chart to help you better retain the main points. You will grasp some metrics even better through practice, and little by little, what once looked like a confusing financial statement will appear more and more clear to you. I'm sure after our next lesson dealing with cash flow statements, you will make even greater progress. So in the next class, we'll begin our study of cash flow statements. Hope to see you there!